Let's do a quick overview, chapter 1, and what we learned last time for this accounting for in the business environment. Accounting. What was the accounting? Accounting basically is right information from wrong data. That's one of the definitions that I saw for accounting. An accountant is the person that most likely know everything about the company, but is less likely to do anything about it. That's another definition that I learned from surrounding about accounting and accountant. Obviously, those are jokes, and now let's start with the serious part. What do we need accounting? Because people always wants to measure what they want to measure, business financial activities. How they're going to measure it in dollar amount, preferably, or some currency amount. In order to do that, we have to do a process, and we have to process the information. And we're going to put that information in type of records. And once we prepare enough records for them to see how much they're making, how much they're losing, and everything, we're going to communicate those reports with the users, with the decision makers. Which are the decision makers? Last time, as we saw from the accounting equation, the outside people are two parts, creditors and lenders and investors. Before we go that, obviously we have to prepare financial statements because all those people who we see here, they're interested. What's interesting with the creditors and investors? Interesting with those people is they want to make money. What do they have? They have money. Because they have money, they want to make more money. Same thing with the bank. First, they have people's money and they're making their own money. Now they have to convince the people to give them their money. So in order to have money, so they can start giving the other people money so they can make money. That's crazy. But that's how it is. So accounting information, we're going to prepare it for the creditors, investors, plus all the other set of users, which can be personal use, can be government. It's very interested in your financial statement or business financial statements. Why? Because the government chasing some other things. Financial management accounting, the main difference is financial accounting is oriented to the outsiders of the company, which are for the money makers, which are investors or creditors and lenders. Management accounting is focused for internal users, which are still money maker, but inside of a company, they would the one who changing the process and make operation profitable or not profitable, depend on the manager. So let's keep going with this. External users are interested in the financial reporting. Why? Because again, they have to make a decision: should I lend money or should I invest in the company? Three type of businesses or three form of businesses that the way we can organize the business can go with the proprietorship where we have a single owner, we have a partnership, we have two or more partners, and we have a corporation which we have a separate legal entity. What's interesting here, the interesting is if you want to open your business and you want to open it right now, you can easily start proprietorship. If you have a partner, then you can share the interest and knowledge and revenue with that partner. And the last one is the corporation. The principles of accounting. In order to have accounting, we have to follow some principles. The interesting thing with accounting in Canada is so we're following accounting principles. Depends on the type of the company, depends on the business. We have a different set of accounting principles. One are for the public company, which has to follow international financial reporting standards, and the other one is for private company, which have to follow accounting standards for private enterprises. Both of those are governed by the general accepting accounting principles. In order to understand everything, looks like this kind of type of construction. where we have a solid foundation. What's on the foundation side? On the foundation side are the assumptions, principles, and constraints. All those assumptions, principles, constraints have to be applied to all prepares for the financial statements in order we to have the solid base from our building. And then we start building, going up. First, we're going to find the elements of the financial statements. Then we're going to find out what kind of characteristic those financial statements have to have. They have to be relevant, they have to be reliable, they have to be comparable, and they have to be understandable. And the last one is to actually prepare those financial statements, which have all this quality. Everything in those statements is in form of asset, liability, equity, revenue, expenses, gain, losses. And all those elements of financial statements having the same, following the same assumptions, principle, and constraints. That's how we should look at this part of the accounting. Everything has to have a solid foundation. Once we have a solid foundation, then we can go and climb up. And until we go to the basic accounting formula, which we talked last time, or assets equal to liability plus equity. Once we know that formula, now we can start changing the bubbles left, right, right, left. So which are available options for this formula? I'm going to flip for a second Excel spreadsheet and I'm going to show you available options that we have using and only the formula assets equal to liability and equity. That's a basic in all accounting. That's the way if we have to say what's the basic in the accounting, that will be the basic in accounting. So if you don't understand something, go back to the basic, which is asset equal to liability and equity, and try to explain it with asset equal to liability and equity. So let me share my screen with the Excel spreadsheet, which is gonna look like this. Okay, and then what we're gonna have here, I'm gonna highlight those one, just to emphasize on those formula. That way we have assets, should be capital, which is equal to liability, still capital, liability plus equity. Now all those things, we're gonna have different inclusion in asset, liability, and equity. But what I want you to remember for now is the basic counting equation: assets equal to liability plus equity. Now, what's available option of this formula? Out of this formula, we can express the equity. And equity always gonna be equal to, let me do this one, always gonna be equal to assets minus liability. From here, I can express also, based on the first formula, I can express also liability. What's liability? That will be equal to assets minus equity. That's another option that they have. Assets minus, oops, not like that, more like this, equity. And the last option that they have with this formula, that's pretty much cover all the options that they have for one side and the other side. When we have two-side equation, the last equation I can do like an asset minus liability minus equity. It's gonna give me, what's gonna give me? Can somebody guess? What I gonna get if I have asset minus liability minus equity? Any guess? Let me see what you're saying in the chat room. Zero, absolutely. It's going to give me absolutely nothing. Zero. You're absolutely right. Nothing. Those are the options that they have from the main formula, which is asset equal to liability and equity. There's no other options. Unfortunately, I'm limited to only to those one, option two, and option three. So now, in the asset, what we said about the asset, that's the capital, company capital. From where the capital comes from only two sources. One is called creditors, and the other one is called investors. What both want, creators, investors, what they want, they all want only one thing. They want cash. Now, how they gonna get the cash, that's a different story. Creator, what they want, what the creator chasing. When you go to the bank and ask them for money, what the bank wants?
Interest.
Interest. Is there anything else that they can get? No, interest. How about investors, what they want? They want also cash, but how they gonna get the cash from the company? In form of dividend. Make sense? Those are the forms that we can get. There's nothing else here. Obviously, those creators later on, once they get the interest, they want the principal. Investors, they just want dividend. Are we going to give them their investment back? No. Once they invest, that's it. Come. We can celebrate. Because we get their money. Do we have to pay them back? No. Now, later on in the 1210, we're going to see when we can give them dividend and why we can give them dividend, and is there any options we not to give them dividend, and we're going to see different options here for the dividend. But basically, all of those creditors and investors, what they want money. Why? Because they have money. With money, you can make more money. If you don't have money, you have to make the money. How are you going to make the money? Open your business or start generating. From where the money coming? Obviously, profit. She is right. But how are you going to generate the profit? Tell me, people, how are you going to generate profit? I want to generate profit. How can I do that? How can you generate profit? Any suggestions? Mm-hmm. Sales revenue. Now we're talking. Okay, good. Now we're going to have assets which are equal to liability plus equity. But now, if we take a look perspective of the business, the perspective of the business. Now we open. Don't forget, we open the company only for one reason: to generate profit. So business is open to generate profit. If the business doesn't generate profit, what's going to happen with the business? It's going to disappear. So how are we going to generate the profit? By sales. One source. So the source of income for this for our business source of income is the revenue or sales. So and then we're going to have expenses. As long as the revenue sales are more than expenses, we're going to have income. If the opposite is correct, then we're going to close the business. Correct? So now, knowing that, don't forget that we're looking from the point of the business point of view. From the business point of view, when we have it, or when you have your own money, those are your own money. Once you put it in the business, those money now those funds become part of the business. Now, to some extent, if you're running sole proprietorship, you still kind of have those money, but again, those money belongs to the business. So technically now the business owes you money. Do you understand this logic? Okay, so now when the business have the assets, now the business owe money to the outsiders, which are the creditors, and to investors. Now, on the sole proprietorship, most likely the only investor will be the person who actually opened the business. So now the owner of the business is the investor. He doesn't have any outside investors. In that case, equity belongs to the owner of the company. Now, this just happened the fact that he's actually running the business. But in reality, when you see later in the accounting in 1210, you're going to see there's a corporation. With the corporation, the investor doesn't actually be in the company. In the contrary, he's somewhere else doing what he's doing, somebody else working for him. That's the general idea. Somebody else to work for you. But in order you to do that, you have to start the business. Once you start the business, then it's easy. Now let's go back to here. In the beginning, in the very, very, very beginning, what we know? We know that assets are zero. Before we even start looking to start open the company, we know that from the accounting equation, let's move it here. We know assets are zero, liability is zero, equity is zero. That's how we start the company. Everything is zero. Now we want to start the business. Now, okay, that's awesome. That's great. But that business need to generate, in order the business to work, it needs to generate revenue. And you need to know make sure the revenue. And the question is, how can I generate revenue? Well, let's say what we selling? Let me see what they have. Let's say we're selling mugs, right? We're selling mugs. Okay, great. In order to sell the mugs, what do we need to do? Can I sell the mugs if I don't have the mug? No. So what are my options here? I believe I have two options here. Which are my two options?
Buy them and resell them or make them.
Exactly. Is there any other options? That's pretty much everything. So I have two options here. Either I'm gonna buy it and then I'm gonna sell it. Either I have to make it and then I'm gonna sell it. So in order to generate that revenue, what do I need? I need the expense, correct? Obviously, I need the cash, and then I'm gonna use the cash to generate the expense, and then I'm gonna generate the revenue. So which one comes first, the revenue or the expenses?
Expense.
Expense, always expense comes first, right? Even if you, let's say even if you want to cook something at home, you won't be able to cook anything before you pay the groceries, cook, and then you have the enjoyment of revenue, and that revenue actually is gonna be your benefit of cooking and eating whatever you prepare. So expenses are always first. So now, again, let's go back to our business here. In order to run my business, I need to have revenue and make sure the revenue and the expenses. But before to get the revenue, I need the expenses. So in order to get the expenses, somebody says here, I need cash, but I don't have the cash. I don't have anything, right? Cash is my asset. What should I do? Get the loan. Okay, let's go. RBC. I want a loan from RBC. What RBC is going to ask me?
How are you going to
What's
repay it?
exactly why? Because they want their money back plus the interest. So what they're looking? They're looking at net income. Do I have net income? No. Why? Because my expenses are zero. How much my revenue? Zero. How much my net income? Zero. Why? Because I have zero cash. So is the bank gonna give me credit?
No.
No. Solid, loud, no. How can I show the assets? I don't have anything. The company is zero. So this one is dead end for us. This one is gone. This option doesn't exist. So what's the other option? What's the other option, people? We have two options here. Creditor, investors. What's the other option? Get investor. Okay. So I'm coming to you. So listen this carefully. I'm coming to you and say, my dear students, I want to open my own business. Would you invest in my business? What you gonna say?
What does your business do?
Exactly. Well, I have the business plan, and okay, I'm showing you a business plan. What's the next question? Let's pretend I have the business plan. How much it cost? Well, I'm planning to make a new development down in Langley or in Abbotsford. New development that will be a 30-story building, concrete building, with mostly 2-bedroom and 3-bedroom apartments. The 2-bedroom apartment is going to start 1,200 square feet. The 3-bedroom start 1,800 square feet. 2-bedroom, 2-bathroom. All of the units going to have a fireplace. The ceiling will be high ceiling, not the standard ceiling, a little bit high ceiling. Uh, and the 3-bedroom apartments in the 3rd bedroom actually is going to be size of the normal bedroom, and the master bedroom will be master bedroom, not like some developer making the master bedroom like a 2nd bedroom, and the 3rd bedroom looks like a more like a den. That's my idea. The cost is gonna be around roughly, let's say, $10 million. Would you invest? On what they're offering instead? Okay, so far only questions. Nobody asked me how much do you want, correct? So what should I do? Pretty much I'm out here on the dead end with you. Only questions, questions, questions. So what should I do? I want to run my business. Oh, let's say let's forget about this development. I run my coffee shop. I want to run my coffee shop. So far, I have zero cash. What do I have to do now? Investors, people that don't want to invest in that. Let's pretend you don't want to invest. What should I do? I still want to open my business. What should I do? Come on, people.
Borrow from family,
From
friends, yourself, your personal assets,
personal assets. So who's gonna be investor now?
the business owner.
The business owner or me. Do you understand this? That's how everything starts. Unfortunately, that's how everything starts. Everybody wants to see some operation, and once that operation kind of prove, then they want to, if it's turned out to be profitable, they chasing you, say, hey, can I invest? Okay, you didn't invest when I didn't have money. Now I have money, I have profit. So no, I'm good. Why? Because if you invest in my company, I have to share my profit with you. I don't want to share it with you. Now I want to keep it for myself. Make sense? So that's why in the beginning, you need the investors. You barely there'll be a creator who's gonna give you cash. unless we're talking about the loan sharks, which loan sharks want some, I don't know, ginormous loan. Here you can go with the what was the reality
Shark
Shark
Tank?
Tank. Yeah, Shark Tank. You can go with that
Dragon's
reality.
Den?
Dragon fan, whatever you call it. Yeah, that's where I know Mark Cuban is one of them, and there's the other Canadian guy who doesn't want to be prime minister. Uh, but yeah, he's also there, right?
Oh, Kevin O'Leary.
Yes, exactly. What they're looking for. They want to be investors, either they want to be creators. Why? Because they have the cash. So now what's the first thing that they're looking for? What's the business? What kind of revenue you generate? Who are the clients of the business? How much you put? I mean, how much risk you take? Show me the prospects here. Show me the product. Show me how many clients you have. Show me where you're right now. And then I'm going to decide, should I invest here or should I give you a loan? And or should I give you and want on the loan uh, I can invest and want a royalty. That means I won't guarantee percentage. Or I can lend you the money, but I want my interest and my money back. Right? And there are different options here. That's what now when you start watching that reality, now watch it closely and ask for the questions that these people asking. Are they going to invest in the business that the owner who started the business didn't invest anything from himself? Probably not. Why? Because that person, he doesn't want to take a risk. Why should I take the risk? Make sense? So, okay, so let's say you found the cash. So what you're going to do now? You're going to give that cash to the business. Make sense? Let's say we found $100 cash. We put it in the business. Now the accounting equation starts looking like this. Now my liability is still zero, but my equity starts climbing up. Where's my equity now? $100. Now with the $100, you start generating expenses. Now, since those expenses are for business, you're expecting with those expenses to generate revenue. So let's say you're spending you. Let's go with the Rockefeller idea. Well, do you know how the Rockefeller started his business? He had $1. He bought for $1. No, yes, with $1 he bought two apples. He shined the apples and he sell it for $2. With the $2 he bought four apples. He shined it and sell it for $4. And then the reporter asked him, "Is that how I become a millionaire?" He said, "No, no, no, no. My uncle passed away 1 week later, and he left me $10 million." Right? So if you think you're gonna get $1 million with shining apples, it's not gonna work. It has to be something else. But that's work for him. Now with us, with the $10, we have to generate expenses. Let's say we buy 50 apples and we're spending $50 now. Or 50 apple with $50 we can buy 100 apples. And we're selling every single apple for $1, so we're generating $100. Now we can have a net income of $50. At this point, once we generate $50, we have two options. Option one, to keep the 50 now the cash gonna go up. Make sense? If we buy the apples and sell the apples, our cash now is going to increase to 150. Our liability, we don't have liability. Our liability is going to stay zero. But on the other side of the equation now, we have the original $100 plus the $50 from the net income. Now we have here 150. At this point, you have two options, the way I see it, or the owner of the company has two options. Take out the $50 out of the company and go buy himself a coffee. Or leave the $50 in the company and keep buying apples. It's not such owner's decisions. Make sense? So the other thing that we can do with this equation is actually not the other thing, the last thing that we can do with this equation is to figure out something very simple. Percentage-wise. Now, this is a capital, right? And percentage-wise, asset divided by asset as a percentage, how much is it? If we have the formula asset divided by asset, how much are we going to get? 1 or 100%. What we're going to have on the other side? Well, on the other side, we're going to have 1 as well. Why? Because whatever we have on the other one side is going to be equal to what we have on the other side. So on the other side, what we said can be on the other side, the equation can be more than 1 or 100%. Is it possible? Is it possible to get on the other side more than 100%? Very unlikely, right? So when we get those two, it's always going to be equal to 1 or 100%. Everything that we get for the investors, always going to be 1 or 100%. So what we're going to have on one side, we're going to have here, we're going to have 100%, which is equal to, if we don't have creditors, then that means everything is invested by the owners. Make sense now? All right. So having this in mind, let's do a question. Let's do one question together. The question is, I'll show you where the question is, and you can get it for yourself as well. Let's go here and let's go to Blackboard. Can you guys see Blackboard? What I want you to do is in the course shell, that's not your course, that's the morning class. Let me go back with the courses here. Let's go to your course and course shell. This is the course shell that I have for you. Let's go to the course content. Let's go to chapter 1. And on the practice question, can you see practice questions? On that section, I want you to click on the site. It's going to open new window. And on that window, I want you to, let's go with the first question. Question 1-1. Once you open this question, we're going to see this different questions here. Let's make it bigger, like this. And even more bigger. So you can see the questions here. So from those situations, you have 3 options. One is to be part of financial accounting, the other to be part of managerial accounting, and the third option to be part of taxation. There's no other options. So let's see which is the scenarios. First one is the financial statement for external auditor. Whose responsibility will be financial accounting, managerial accounting, or taxation accounting? A. Yes, that will be financial accounting. No questions about it. Planning transaction to minimize tax paid. What do you think about that? Clearly tax accounting. Cost accounting. Who's going to do cost accounting now? That will be B. Okay, preparing financial statements, obviously. That will be A. Review financial reporting for compliance with Provincial Securities Commission requirements. Who's going to review the financial reports with the compliance Provincial Securities Financial Commission requirements? Why the management accounting? The management accounting, they were inside. They need it for something else. Why taxation? There's no taxes here. Provincial Security Commission requirements. Security Commission, that means the stock exchange. Yes, financial accounting will be the right one. And we're reviewing the financial statement to compliance with the Provincial Security Commissions, which is the stock exchange. How about budgeting? Who's going to prepare reports for budgeting? That will be B, right? Management accounting. How about internal management reporting? Something internal for the company. B. Investigation of the violation of the tax law. That's obviously C. Okay, great. Awesome. Let's make it back to normal. On and let's go with the next question. Now the next question will be question 2, but I'm gonna leave it for you for now. Let's go to question 3. And let's do together question 3. Now for question 3, in order to do it, I strongly suggest you to download the document and do it together. I'm gonna save it here somewhere on my device, and once I have it, I'm gonna open it as a Word document, and it's gonna look like this. So the other thing that they have to do is have to enable editing. And now I can actually write something in this Word document. So what's the idea here? Idea here is to keep the accounting equation in balance, asset always to be equal to liability and equity, and to follow those transactions and see which side is affected. Is it asset? Is it liability? If it's liability, how much is the liability? If it's asset, how much is the asset? If it's equity, how much is the equity? So let's go with the first. This person, he's the owner of the company. He invested $25,000 cash from his personal account. He invested to the business. So what the business get? We cannot see the document. Am I not sharing it? No, you don't. I'm not sharing this one. Let's stop sharing this one. I see why you cannot see it. How about now? Is it clear now or it's too small? Let's make it bigger, like this. And let me eliminate this part here of the Word document. How about now? Can you see it now? So let's go. First thing first, the person invested cash, $25,000 from his own cash into the business. What the business get? We already have suggestion the business get cash. How much cash the business get? That will be 25,000. What the owners get? He get a capital. Is there any liability here? Can you guys see my screen? Are you guys with me or I'm going too fast? So what's the liability here? 0. Okay, great. Let's go with the next question. Letter B. The owner purchased office supplies on credit. Now what the business get? Asset. What kind of asset? Office supplies. For how much? For $600. Okay, let's get this office supplies. Now, the next thing is Did the owner pay for it? No. So there's no cash payment, correct? But does the owner have to pay for it? Yes, somewhere in the near future. So what's this for the owner then? It's a liability, correct? What kind of liability is that? That will be accounts payable, 600. So now, am I in balance with the equation? One asset goes up, liability goes up. Okay, great. Let's go in the letter C. That's our letter C. Now, he ordered furnitures for $7,000 on account. What the business get? The business gets furnitures, which we can change it here instead of equipment to say furnitures, but we can leave it equipment. Furnitures, how much? For how much is the 7K? $7,000. Okay. Now, did the owner pay for it? No, no cash is involved. So does the owner have to pay for that equipment? Yes. So what is the for this for the owner then? It's a liability, correct? Or accounts payable, 7,000. Okay, great. Any equity here? No. Next one. The owner complete application for 10,000 towards government grant. That's letter D. What we're doing here. What the business get? Owner filled the application. What the business get? Now let's take a look. He complete application. Nothing yet. That will be the right thing. Here, so example, watch this. You went to the Douglas College and you check what will be the tuition fee, not, yeah, what will be the tuition fee for bachelor in Douglas College. And you fill up application form for the bachelor, which cost, let's say, $15,000. Do you have to pay? No. Why? Because you just filled the application. Do we get the grant? We don't even know if we approve for the grant. First, you have to get approved for the grant, then you have to get the grant. So many things have to happen in order this to become a real transactions. For this, in this case, what we're gonna say then, not applicable. Sorry, owner, keep doing what you're doing. That's great that you filled the application. If there's something, if there any movement on that application, let us know. And if you get the cash, we're gonna do the transaction. Now let's see, letter E. The owner paid for the office supplies in B. Where is B? This is the B, so the office supplies has been paid. What that means? How did we pay? How did we pay? Cash. So what's happened with the cash? Going up or going down? Minus, okay, minus 600 cash. Okay. What else going down? Did we pay for this? So no. Before we jump into the equity section, did we pay for the office supplies? No. What was when we purchased the office supplies? What's that for us? Is it equity or liability? Liability. How's the liability go? Accounts payable. Correct? So now we have the liability. Now we're paying the liability. What's going to be affected? Liability or equity? What's going to go down? Liability or equity? No, okay, let's go. Let's pretend for a second I deducted from the equity. Let's pretend for a second, 600. Now, if I do this, what's going to happen with the owner's capital? If I put those $600, if I take it out from equity, what's going to happen with the owner's capital? It's going to go down with $600, correct? Do I still have to pay this accounts payable? Yeah. So if I take $600 from the equity, did I clear my accounts payable? No. And if I leave it the way it is right now, the way it's on the screen, I'm not reducing the accounts payable. My accounts payable before this transaction was 7,600. After these transactions, which I don't have now $600, but my accounts payable is still $7,600. So you're telling me that I'm paying for this accounts payable, which for the office supplies, but I'm gonna take it for the owner's capital. Is that the right thing to do? What do you think? If I'm paying for the something that I haven't paid yet, can I take it from the owner's capital? No. Are we all agree on this? I want to see full agreement on this. So what I'm gonna reduce then? A liability. Which liability? Accounts payable. With how much? With $600. So what happened now? Before this transaction, I have to pay these suppliers $600. After this transaction, I don't have to pay them anymore. I just pay them. They're done. Liability disappear. No more liability. Last one, letter F. The owner withdraw $1,250 cash from the company. Now, who take the cash? The owner. Cash. What's happened with the cash? The cash gonna go down. How much? $1,250. What else going down? Now we can say equity. Equity going 1,250. Make sense? Awesome. And what we can do now? Now at the end we can see how much we have. Okay, let's see. On the cash, what do we have as a cash? On the cash we have 25,000. We get 600 paid for the supplies, and the owner get 1,250. So we have 2,350. Is that how much you get? Okay, 150 dollars. Equipment, 7,000. Office supplies, 600. Accounts payable. How much left we to pay? 7,000. Why? Because we initially we didn't pay for the supply 600 and for the equipment 7,000, but then we pay for the supplies, so then only for the equipment left 7,000. What's happened with the owner's capital now? Once he take 1,250 minus of 25 that he initially invested, now his capital went down to 23,750. Are we in balance? Which we should be in balance, but are we in balance? Yes, we are. So why? Because my assets are, how much is my assets now? 23,150 plus 7 plus 600. I have 30,750. How about on the other side? Do I get 30,750? Yes, we get. Now we can say, yes, we are in balance. Okay, let's do another one now. Let's close this one and let's do another one. If you're looking for the answers are just on the second page. Okay, I'm gonna close this one and I'm gonna open another one. I'll show you which one I'm gonna open now. Let me share my screen first and show you exactly what I'm gonna open. On Blackboard, that was question 1-3. What I want you to open is question 5 transactions /9 Excel format. And I want you to download it. So once you download it, you can open it. And let me share my screen with the opening of this Excel spreadsheet. Let's stop share this one first. Let's share the new one. And that will be the new sharing now. Can you guys see my screen? All right. Let's make it a little bit bigger. And let's start now. Now, what is this? This is an Excel spreadsheet, obviously. It has different sections. One section is for the accounting equation, the very first, which is asset equal to liability plus shareholders' equity. And always we have to keep that in balance. What's going to happen if we are not keeping this in balance? Let's put this equal sign here. What's going to happen on our check mark, which is here, we're going to start seeing numbers. Well, I don't want to see this. I want here the balance to be zero. Why? Because what we said, asset minus liability minus equity should be zero. That's what we're chasing. That's how we're going to be. Things not looking good if they're not in balance. That's correct. We try to keep everything in balance. It's hard to keep it in balance, trust me. It's very hard, especially when you keep it when you're working with humans. It's very hard, but it doesn't mean we cannot try. Let's go now with the transactions. In accounting is very simple. You're just following this rule and everything is fine. Let's go with the first one. Now, the first one says that the shareholder or the proprietor or the owner of the business invested $36,800 cash. What the business get? Cash. How much cash the business get? 36,800, correct? Good business, you get what you needed. What the owners get? Dividend, too early for dividend. Don't even think about the dividend. common stock, but let's change it to the owner capital. So what the owner get? Common shares or capital? Let's leave it one of those. Let's leave it as a capital. He get capital. Are we in balance? Yes, we are. Next one. The owner of the company, he purchased computers, which are recorded as equipment, for $27,600 on account. What the owners get? Sorry, what the business get? Asset. What kind of asset? Equipment. For how much? 27,600, correct? Now, did the business pay for that? No. Then what is it? A liability. Why? Because the business have to pay for it, or the business has to pay for it in this case. Correct? How much? Exactly the same amount. Now the next transaction, number 3. In order to start his business was computer service. In order to start his business, he needs to pay the rent for the office. Otherwise, he cannot work. He paid the rent in cash. What's going down now? Cash. How much? It's gonna go down with 3680, correct? Now, what else going down? Went down. What else gonna go down? Owner's equity. Why? Because expenses is gonna reduce his equity. Make sense? So his equity is gonna go down with 3680. And now we in balance. Number 4, the company performs service which worth $7,480 on account. So what's happened with the company? What they provide? What the company provide? Service. To whom? Who is the receiver of those services? In the nature, when we start business, who to whom? To the client. Excellent. The client. So if we perform something for the client, what we generally getting from the client? Revenue. Excellent. How much is that revenue for? $7,480. What's going to happen with the owner's equity now? Owner's going to say, oh, thank you. Finally, I'm getting something. Revenue goes up. Finally, something comes for me. Excellent. Now let's see. The equity is going to go up with 7,800 because we're generating revenue. Did we get the cash? No. Do we have to get the cash? Yes. So what will be that for us? Accounts receivables. How much? $7,480. And now our check is zero. So that means asset is equal to liability plus equity. Make sense? Let's go to number 5 now. What's in number five? Now, we're still performing computer services for another company, but this time we get the cash. So let's get the cash. Once you see we get the cash, get the cash first. Finally, we get some cash. $4,600 cash. Welcome cash. Did we get the cash? Or from whom we get the cash? From the client. Why we get the cash from the client? Because we did some service for the client. What's that for us? Revenue. $4,600 revenue goes up. Equity goes up as well, which revenue is gonna drive the equity up. Now, next transaction. What's the next transaction? I believe I have to do some mapping here because it's gonna start changing the numbers, but just quickly do this and then I continue with the next transaction. Number six. For the number six, we pay cash for the electricity. At the end of the month, bill for the electricity comes, we have to pay $7,360 cash to BC Hydro or full power, state power. What's going down? Cash going down, right? How much cash going down? With $7,360. Bye bye cash. Welcome what? Expenses. How the expenses gonna affect the owner's equity? When the owner see expenses going out, what's he's gonna do? Oh my God, expenses again. He's gonna start crying, right? Why? Because his equity start going down too. On the revenue, he's happy, but on the expenses, not so happy. Why? Money going out. So how much gonna go? His equity down? $7,360 go down, and we keep the equation in balance. Number seven. What's happened? Number seven. Remember, we purchased computers in number two. Now we're gonna pay for it. With those computers, we're gonna pay it. What's gonna happen now? Before we pay for the computers, we have cash. After we pay for the computer, what we don't have? Cash. Cash gonna go down with $27,600. Bye bye cash. Now, how this gonna affect us on the other side of the equation? Why I'm paying cash? Because I didn't pay originally for the cash. Now I'm paying for the cash. So what's gonna go down? Owner's equity or the liability? Accounts payable. Okay, good. Minus 27,600 goes down. And now we're in balance. Next thing, the company had advertising expenses for the month of May, which they didn't pay. It's on account $1,196. So hold on a second. Did we pay cash? Before you jumping without cash, did we pay cash? No. Is it clear that we didn't pay for the cash? Well, we didn't pay for these expenses. Okay, great. It's clear that we didn't pay. Excellent. Now, is the cash involved in them? No. What is involved? Definitely expenses. The expense is going up, so the retainer is going to go down. The owner is going to start crying. So negative 1196 expenses, but something has to go up now. What's going to go up? Do we have to pay for these expenses? accounts payable is going to go up with the same amount, 1196. Why? Because we didn't pay for these expenses. Imagine if we use the cash is going to go down with the same amount. But since we didn't pay cash, accounts payable going up to balance the reduction of the equity in form of expenses. And the last one is the let's get some cash from the customers on the contract that we did in number 4. So what's happened now? Is the cash involved now? Shada? Yes. How? Plus cash. Yes. How much? 11,040. Now, something has to go down now. Or on the other side of the equation, something has to go up. What's going to happen now? Accounts receivable. What's going to happen with accounts receivable? When the customer pays, going down. With how much? With exactly the same amount. Are we in balance? Yes, we are. And I believe that concludes everything. Now, what we have to do now? Let's get the totals. Total 1. Boom. Cash is 13,800. Accounts receivables 6,440. Equipment 27,600. Accounts payable 1,196. Owner's capital 36,800. Revenue 22,080. Expenses 12,236. Are we in balance? Let's check if we're in balance. Let's draw this one down. We're in balance. So whatever we have on one side is equal to the other side. So our total is correct. Let's highlight this total because that's important for us. Okay, we have the total. What we can start doing now? We can start preparing. Wait, why did we put the last question on cash and accounts receivables? Let's go back and see. We receive $11,040 cash from customer for contract built in 4. What's happened in 4? We perform service on account for 17,480. So we get the revenue and the client didn't pay. So that's for us accounts receivables. Now the client decided to pay and he paid us not 7,480, he paid us only $11,040 cash. What did we get? Fabiana, what did we get? What the business get? So hold on a second now. Before you start getting income, Shada, don't go with that because the income was generated when we perform the service. In number 9, when we get the cash, are we providing new service to the customer? No. What the customer what the customer doing then? He paying for something that he didn't pay in the first place. Make sense? In here, in this transaction, we have this transaction, but the customer didn't pay. Suddenly, he decided to pay. What he paid? He paid the cash. Is there income here involved? No. Then what is involved? One asset goes up, the other asset goes down. Which is the asset that goes up? Cash goes up. Which is the asset goes down? Accounts receivable go down. Now, if the client has to pay me 7,480 and he pay me only 11,040, did he clear his outstanding balance? Yes. That's exactly what we're gonna say. He's supposed to pay me. I provide the service for 7,000. He decided to pay only 40. Do we still have to collect from that client? Yes. How much? $6,440. Fabiana, does that make sense now? Excellent. Let's keep going now. What we have? We have the cash. We have the accounts receivables. Why we have accounts receivables? Because on the service that we provided, we 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 were partially paid, not entire service paid. For the equipment, we have the equipment. Then the accounts payable. On accounts payable, we pay for the computers, but for the advertising expenses, we haven't paid yet. So that's why sitting in accounts payable, we still have to pay. Owner's capital is owner's capital. Revenue is revenue from the service that provided to the customers. And the expenses are the expenses that we need to do to run our business. And that's what we have. Now, what we have to do? We have to start preparing a report, which is the first report that we have to prepare. Usually the owners always and always asking, first question is my business profitable? So for that reason, we have to prepare income statement. And in the income statement, what we're going to have? We're going to have revenue, or we can easily get it from right here. That will be revenue. And then we're going to have expenses. How much is our revenue? We already calculated. The total revenue for the period is 2280. How much are the expenses? We already calculate them, but we want it as a positive amount, that much. So what's the next one? We have to calculate how much is the net income. Is that this company generating income? Is the revenue more than expenses? Looks like it, right? So this one minus expenses. Okay, this company generates 9,844 net income. So when the owner, how is the business doing? We generating income. How much is the income? 9,844. Excellent. How much I have? How much is in my account? So in order to answer that question, we have to prepare statement of owner's equity. Now, how are we going to prepare this statement? First, we're going to start with the beginning balance of the period. Now, how was the beginning balance of the beginning of May? It was 0. Then what's happened? The owners contributed capital. That will be the contribution. How much he contributed? He contributed 36,800. What else happened here? It happened that the company generated income, correct? How much exactly the company generated? 844 dollars. So, is there any dividend? No, 0. Dividend is 0. So, what's the ending balance now? Ending balance, it's gonna be equal to beginning balance plus contribution plus net income minus dividend. Or what we can do here is very simple. Net income will be at the net income and dividend will be less dividend. Now we know how much is the owner's equity. What's the next thing that the owner's gonna ask you? Okay, I can see I have $46,644 belongs to me. Where they are. For that reason, what we have to do, we have to prepare a balance sheet. What's gonna be on the balance sheet? One side will be assets. On the other sides will be liability and equity. And here, somewhere equity. Assets. How many assets we have? We have cash. We have accounts receivables. And we have equipment. How much is our cash? The cash is 13,800. Can you see it? How much is the cash? We already calculated here, people. Cash for the period is all this together, correct? 13,800. Accounts receivables. How much we still have to collect from our client that pay partially? 6,440, correct? And we have the equipment, which is 27,600. Now what we have next? Next will be total assets. How much are our total assets? All these three together. Our assets is 47,840. Do we have liability? Any liability do we have? Let's take a look. Liabilities. Do we have balance on the liability? We do. Why? Because we didn't pay for the advertising. Let's show it. Accounts payable, 1,196. And that's all. Equity. Owner's capital. How much the owner's equity? We already calculated. 46,644. Now, how much is the total liability plus equity? Are we in balance? Yes, we are. So what we have to do now, we have to make it nice and shiny. Let's put this one in blue. Let's put it this way and let's highlight it to the owner. And that's your income statement. And highlight the income statement. Here we go, dear owner. So your company generating $2,280 revenue, expenses are 12,236. So your income is $9,844. Now, how much is your capital? Your capital, dear owner, is in the beginning of the period, you didn't have anything because you opened a business. You contribute 36,000. The business itself generating for you $9,844. So your ending balance, or you have available at the end of the period, $46,644. And the owner asks you, where are those? Well, In order to find out, we have to take a look at the balance sheet. So, as an asset, you have cash for $13,800, accounts receivable $6,440, and equipment for 27. Your total assets that you have available are for 47,840. With those assets that you have available, you have to pay your liability, which is accounts payable for $1,196. Once you pay your liability, everything else is yours. So you can enjoy it. But you have to pay your liability. So with the assets available, once you pay your liability, you're gonna have $46,644 assets worth for you. Make sense? And that's how you're explaining the whole situation. What we can do here to make it fancy, I can put here, merge all those cells, and that's my balance sheet. Shall we do one more question? Yes, let's do one more question. Okay, before we do one more question, let's go a little bit for the slides. Again, I'm gonna stop share this. Now, this document, what I'm gonna do, I'm gonna save it. And just stay with me here. Bear with me. Then today, this one will be no, we're still in chapter 1. That will be calculation or answer. And today is May 11, 2026. Save. So what I'm gonna do is, watch this. I'm gonna go to Douglas College website, obviously. Once I go to the Douglas College website, right here, I'm gonna click now something that it's called. Second, let's give me a second here to see it. Edit the content. And you have one answer here, but I'm gonna add it here. Another answer here, which will be from today. Upload it. And I'm gonna upload it right from, I believe if I save it here, that's my answer here. Boom, save, and you have it. Right now it should be available for you. Now you can download it and go over the answer. Make sense? Now let's go to the slides. Let me share my screen with the slides. So now let's go back to our idea with the assets, liability, and equity. What is the asset now? Now, once we see some transaction, what we can say for the asset? Asset is economic resource, which is controlled and held by the company or the business, and for which business expect to generate future benefit. Those are the example of assets. Let's see what's the liability then. Liability is obligation for something that company has to pay in the future because did something in the past. And that brings us to the owner's equity. What's the owner's equity? Well, owner's equity simply is the asset less liability. How we can differentiate based on the business? Well, for the sole proprietorship, we're going to have the owner's equity. For the partnership, we're going to have partners' equity. And for corporation, we're going to have a shareholders' equity. Why in the sole proprietorship, we're going to have owner's equity? Because it's not corporation. It's just everything belongs to the owner. Owner equity, that's for simplicity. Partnership, well, the partners have their equity, again, not separate entity from the individuals. Corporation, separate entity. For that separate, we have the shares. How the people can get the money then? In the sole proprietorship, the owner of the company is simply gonna withdraw cash. When he withdraw the cash, that will be considered a reduction in his owner's equity account, owner's capital account. On the partnership, same idea. People want cash, they withdraw the cash, that's reducing their interest or their equity in the partnership. On the corporation now, the shareholders cannot go and get the cash from the cash register. That's not going to happen. If you own one, so for example, imagine this: I'm buying one share for Apple, and I want dividends. So what I'm going to do? I'm going to go to Metrotown Apple Store and going to tell the people, "Hey, give me one cell phone." Why? Because I have one share and I want a dividend, and you can put it on my account. It's not going to work that way. So when the company decide to give you dividend, then you can get your dividend. You cannot go just simply go there and withdraw whatever you want to draw from the business. It doesn't work. Only works for the sole proprietorship and the partnership. Now let's see. For that being said, now the owner's equity. What affects the owner's equity? We already saw when the owner invests or contribute cash in the business, his equity goes up. When the business generates revenue, equity goes up. When the business have expenses, owner's equity goes down. And when the owners withdraw cash from the business, owner's equity goes down. So in that case, what's the revenue? Revenue is what the company generated by two options: providing services or delivering goods. How the goods get it on the first place, that depends. It depends on the business. We have a merchandising, we have a manufacturing company. So in order to deliver the goods, either you have to buy it and sell it, either you have to manufacturing and then sell it. For the service, it's just a service. So when is the revenue? Revenue is when you get the cash or when you will be getting the cash in the future. So why? Because you already provide service or deliver the goods. Cash is not requirement in this case to be received in order to revenue to exist. For the expenses is the amount that you paid or has to be paid, because there's an option that you don't have to pay the expenses right away. You can pay it in the future. But what do we need the expenses for? Expenses only count if they are for the purpose of the business to generate revenue. If it's not for the purpose of the business to generate revenue, it's not considered expense. So if the owners of the company decide to go to Taylor Swift concert and pay with the company money, that's not involved in the business. He has to pay with his personal money, cash. So now extending the accounting equation, the way we extend it in the question, we're going to have asset equal to liability plus equity. But on the equity, we're going to have original investment from the owner. Net income, which comes from the revenue minus expenses, going to increase the equity. And the withdrawal is going to reduce the equity. Let's do now this question. Now, for this question, since it's from the slides, what I'm going to do is now I have two options here. What I want you to do is, obviously, I'm going to have to use the Excel spreadsheet. I have two options. Option one, copy this, create the Excel spreadsheet, and make it available for you. Probably that will be the best option. And option two is you to create it by yourself. So let's stay with option one. Watch me how I'm gonna do it. So then you can do it by yourself. First, what I did, I copied the slides. The next thing that I'm gonna do is I'm gonna go open the Excel spreadsheet. Let me share my, no, I'm gonna open the Excel spreadsheet that we just work, and that will be the question from question 9. Sorry, question 5. And inside that question, I'm gonna post the slides. Let me show you. So I'm gonna use this question, which we already have. So get the fresh copy, whatever you did, save it. And what I'm gonna do, I'm gonna delete all those things here, and I'm gonna post the one from the slides. And it's gonna look like this. First one is this, second one is this. I'm gonna post everything, and then I'm gonna save it for you, and then we can start working together. Deal? Give me a second, and we'll be with you. Number 4 transaction. Number 5 transaction. There are 12 transactions here, so we need a little bit more space here. But I'm gonna get it. Let me see, because it's cutting here something. I have to make it a little bit bigger. Okay. Now format those one in a second. Just give me a second. Let's keep going with this one. Number 5. I have number 5. Number 6. Next one will be number 7. Then we're gonna get number, so the number 9, sorry, that number 9, number 10. See, that will be that's 6, all the way to 8. That's number 9. And that will be here 6 to 8. Number 9, that's number 10. That's number 11. Number 10 was this one here. Number 11 is number 11, and number 12 is the last one. Insert, and the Lisa withdraw from C, and that will be number 12, and that will be this one. Now, instead of dividend, that we're going to change to withdrawals. No dividends in this company, only withdrawals. And I believe if we have to do some adjustments, we're going to adjust it here later. Now, the last thing that they have to adjust is those cells here. Let me make some adjustments on those cells. Alignment, I don't want to wrap the text. I want them like this. And we're good to go. And not necessarily like this, probably like this. That's perfect. The only one I want to extend is this one here, because on this one here, I'm gonna add a little bit more information for you, the way it's in the question, so you can understand from why those expenses are that much. Mm, Salaries, and the last one is the utilities. Here you go, and we're good to go. So I'm gonna save this one as a question from the slides, and I'm gonna share it with you. Just give me a second. That should be straightforward. Let's call it question 6. Transactions. Okay, we're done with this. Let me share it, my screen with you, and you can see where it's gonna be the question. Blackboard, 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 Blackboard. The second, because I lost the Blackboard on my screen. I believe I found it. I believe this is the one. Can you guys see my screen? Okay, let's post this one here. And let's go together. Let me see, where did I save it? That should be here somewhere. No, it's not here. Let me see where I saved it. I saved it somewhere, but it's not where I thought it's gonna be. Okay, I have it. Let's go back to. Okay, let's try to share it again. Can you try and find it? It should be at the very end of the practice question on chapter 1. And let me know if it's there. Open it, please. And let's start working with this. Let's go one after another. Same idea, like before. First one, the owner invested, obviously that's not gonna be, this one will disappear. The owner, Lisa Hunter, invested $250,000 to start a new business. What she put in the business? What the business get? If she invested $250,000, what the business get? The most important thing, cash. Usually the first transaction always gonna be cash. Why? Because this business wants cash. to run the business. 250, let's make it a little bit bigger so you can see it. Oops, that's too much. Let's go back. $250 cash. What the owners get? You can change this one instead of common stock, change it to owner capital. What the owners get? $250,000 in his capital, correct? Excellent. First transaction is done. Second transaction. The business purchase land for office location and the business paid $100,000. So what the business purchase? Asset. What kind of asset? Land. So what I want you to do is we have to insert a new column. Where the G is, click insert and click one more insert. And let's first one make it smaller, the second one bigger, land. And that's gonna work. If it's hard for you to do it, let me know. I'm gonna share it the way it is right away. If it's hard for you to do it, let me know. I have it saved. I can save it up to this point and I can share this one with you. Let's do that. Let me save the way it is. And if you go to, just a second, let me replace this one, the existing one that is sitting here. Now, if you go to Blackboard and open the new one that is just existing right now, the new one should have a land on it. Okay, let's go. The cash was 250 and the capital went up with 250,000 and we in balance. Now let's get the land. Land is for $100,000 cash. And how did we pay? We pay cash. So what's happened with the cash? Cash going down with $100,000. Let's put one minus so we know the cash going down. Number three, we buy
Okay.
the stationery.
Sure. Sorry, a question.
Yes,
Can why is the land not considered an expense? Because at first I thought about putting like 100K
it's
in
asset.
land,
It's
and
asset.
then no, yeah, but on the other side to balance it, I thought about like it's an expense from the company, right? Like
Uh,
the company
so
is
hold on a second. So watch this. Watch this. What the bank company get? Land, right?
the company gets land, yes,
Yes. Is the land asset?
yes,
Okay. So how the company paid for that land?
with cash.
With cash. So what we did in the general picture, what we did, we replacing what asset with another asset.
Okay,
Before we have cash and we didn't have land. Now we have land, but we don't have the cash,
okay.
right? Is the expense involved? Are we generating revenue with here?
I mean, I would think that I feel like further down the road, the land would allow me to make profit if I put
Yes, but are you making profit right now?
oh yeah,
Right?
oh,
Right now, you're not
that's
making
not
profit.
cons
So now we have to add here, in order to be in balance, you have to add the new cell, which is H. That will be plus this one. Otherwise, you're not going to be in balance. That's another adjustment that you have to do on the calculation at the end. So number 3, the company purchased stationery and office supplies and agree to pay $7,000 within 30 days. How did they do it on the Excel? Go to the cell that shows the formula. Go to the place where the pluses are. So if I don't have this formula here, if I don't have this cell, once I click on the formula here, the cell is not highlighted. That means this land now is not part of my calculation. And since it's asset, I have to add it. So I'm gonna go after the F22 plus click on the cell, enter, and you're done. So now let's go back to the stationary office supplies. We spent 7,000. Oh no, we purchased office supplies for $7,000. What's this for us? Office supplies. Is it expense or is it asset? Somebody says asset, somebody says expense. So listen this. In order to become expense, we have to use it. Once we buy the office supplies, did we use the office supplies? Not yet. When it's going to become an expense? When we use it. In the very beginning, is it expense? No. What is it then? Asset. Is that clear for everybody? In the very beginning, when you buy something, office supplies especially, it's an asset. Until we start using it. Once we start using it, we're going to see how much we use and then become part of this, become expense. At this point, we don't know. So $7,000 is going to be our asset. Did we pay for this? Not yet. Do we have to pay for it? Yes. How much we have to pay? 7,000. What's that for us? Liability, right? So the liability is going to go down with $7,000. Accounts payable in this case. Excellent. Let's go number 4. Now, this company, they earn service revenue by providing environmental consulting services for clients. Now, they assume that the business earn $30,000 and collect this amount in cash. What the company get? So hold on a second now. The company provided the services, no questions about it, and collected cash. What the company get? Cash. Company get cash. Do we understand this? Can everybody see the company get cash? How much cash the company get? 30,000. Let's get those 30,000. 30,000 cash. So now let's think why we get the cash. Why did we get the cash now? Because we provide services, service revenue, we provide services to our clients, and we earn service revenue. Make sense? Yes.
Excuse me, I have a question. When it says assume, does it means we are not getting it? Is it account receivable?
Which one? What says assume?
Number 4, is it
Earn service
assume?
revenue by providing consulting for assume that means
Maybe we
assume
assume.
is how
Yeah, I know what assume is, but I just want to know, it's not gonna go to account receivable?
no.
Okay,
In this case, no, it's so as listen, assume is not the word that's gonna change where it's gonna go,
mm-hmm.
right? That's not the word because I can clearly do the entire sentence that I can ignore the assume and I can put this. The business earned 30,000 and collects
Yeah,
this amount
got
in
you.
cash,
Great, thank you.
right? So that means that the business provides the service to the clients, earn $30,000, so the revenue is earned. So I can collect, I can record the revenue 30,000, and the business get cash. Make sense? Now, if it says the business earned $30,000 and the customer agreed to pay within 25 days, then did we get the cash? No. In that case, would be accounts receivables. So let's see number 5. Number 5 is gonna clear the picture. Again, the service performed consulting services to the client who did not pay immediately. In return for the services, issue invoice. The client will pay $25,000 within 1 month. So what's happened here? Did we provide the service? Did we again provide the service? Yes, we did. So do we generating revenue? How much is the revenue now? 25,000. Okay, great. Did we collect the cash? No. But are we gonna collect the cash? Maybe, maybe not. For now, it's accounts receivables. So let's increase our accounts receivables and to show that we have to collect the cash. Yes, that's probably the right one. We hope that we're gonna collect the cash, the accounts receivables. Now let's go with the next one. During the month, this company pays $12,000 expenses in cash. They pay for the office rent, employee salaries, and utilities. In total, they pay $12,000. So what's happened with the cash now? Going up or going down? Going down, minus 12,000. What's happened? Where is the effect on the other side of the equation? What's happened on the other side of the equation now? Expenses, which is gonna drag the owner's equity down with 12,000. Yes, expenses going up. That means the owner's equity is gonna start going down. Number 7. This one I have to change it. That will be number 9 now. Because number 6 to all the way to 8, I have all those. Number 9. This company pays 5,000 to the store from which it purchased 7,000 worth of office supplies in transaction 3. Do you remember in transaction 3, we purchased the office supplies we didn't pay? What's happening now? We're paying how much we pay? Did we pay the entire amount? Only 5,000. So what's happened with the cash? Going up or going down? Let's get minus 5,000. What else going down? Accounts payable going down with 5,000. Did we clear the old accounts payable? Not yet. We still have to pay certain amount, but we're gonna pay it eventually one day. Maybe. Right? That's number 9. Let's go with number 10 here. What's happened with number 10? Lisa remodel her home at cost of $30,000, paying cash from personal funds. First of all, is her home part of the business? No, it's not. Is this business this transaction part of the business at all? No, it's not. Did she use company money? No. For that reason, do we have to do anything with number 10? No. So what we're gonna say, not applicable. Nice try, but this has anything to do with the business. Sorry. Number 11. What's happened with number 11? With number 11, the business collect $15,000 from the client in transaction 5. So what's happened in transaction 5? We're generating the revenue, but the client didn't pay cash. Now he's paying cash. How much did he pay? The entire amount? No. So let's get the 15,000 cash, reduce his accounts receivables with $15,000, and the remaining will be our balance, correct? All right. And we have to add one more line here for number 12. And what's happened with number 12 now? Let me adjust those cells here. Number 12, she withdraws $6,000 cash for her personal use. What's happened with cash? Going up or going down? Going down. With how much? $6,000 going down. What's going down as well? Her equity. Shareholders' equity going down. With how much? With the same amount, 6,000 going down. Let me see if we are in balance. We should be in balance everywhere. That's no value because it's not applicable. That's obviously. Let's put, if I put here not applicable in this cell, it's gonna be okay. Everything is in balance, we are good. Now what we have to do, we have to start preparing statements so we can answer Lisa's questions. What she's gonna ask first? She's gonna ask, is the business profitable? So in order to get this, let's get the totals first. Cash. Total for the cash will be $172,000. For the accounts receivables, $10,000. For the office supplies, $7,000. For the land, $100,000. Accounts payable, $2,000 left. Capital, $250. The business generating $55,000 revenue. Spent $12,000 expenses and withdraw $6,000. Now let's prepare the statements. First, what we're gonna do, income statement. And for the income statement, we're gonna use the revenue and the expenses. That's all. The revenue total is 55,000. How do we get the total? Okay, highlight all the cells where up to the cell where we want the total to be. All the cells. I want the total to be in this cell. Go on the functions and you can see here auto sum. Click on auto sum, it's gonna calculate it for you. Now in this cell, as you can see here on the formula, I have everything up to this point. Once I have this cell ready, what I'm gonna do, I'm gonna Control C, and I'm gonna start highlighting all the cells, and I'm gonna put Control V, and I'm gonna get Control, and I'm gonna paste this calculation everywhere, rather than doing the same thing over and over and over again. So income statement, revenue is 55, expenses are equal to negative 12,000 or $12,000. So in this case, I'm gonna generate net income. And my net income will be 55 minus 12 is gonna be $43,000. So this business generating net income for $43,000. Let's put it in blue again. The income statement is ready for us. So we can answer the first question. Is the business profitable? Yes, it is. How much did the business generate? $43,000. Second question. What's happened with my account? Statement of owner's capital. What we're gonna do first? Beginning balance. Then we're gonna show the contribution. Then we're gonna add the net income. Now in this case, we have a withdrawals. Let's show the withdrawals. And the net income will be add the income and less withdrawals. And after that, we're gonna have ending balance. So let's see what's happened in this case with this owner capital. No, not this one, sorry. It's just simple line. Beginning balance in the very beginning of the business was zero. Then she contributed $250,000. The business itself generating $43,000, and she withdraw $6,000. So the ending balance in this case will be all this together. So the ending balance in this case is, let's make it. Sorry, the ending balance of the owner's capital is $287,000. So she is entitled from the business for $287,000. Why? Because she contributed $250, the business generated $43,000, and she withdrew $6,000. So for her left $287,000 in the business. Where they are? Balance sheet. And let's chase the assets. What kind of assets we have? We have first asset we have is cash. Second asset we have accounts receivable. Third assets we have office supplies. Last asset left, land. Cash. The cash is 172,000. Accounts receivables 10,000. Office equipment, office supplies 7,000, and land is 100,000. So our total assets are for the amount of $289,000. Is this hers? Not yet. Why? Because we have to deduct the liability. How much is the liability? What kind of liability we have? We have accounts payable. How much is the accounts payable? 2,000. So with the assets that she has in the company or the business, once she pays the $2,000, what's left? Her equity and owner's capital is how much? We already calculated 287. Once we get the total liability plus equity, we're gonna have 289. Are we in balance? Looks like we're in balance. Let's prepare the balance sheet. Let's put it in the green color. Merge those cells, highlight the name, highlight this name, highlight those numbers. Assets are highlighted. Let's put the double line here and double line here. That's green and that's also green. And the other thing that we can do in all those cells, we can make it as a dollar amount with the dollar amount in front. That's need a little bit increase in that cell. And now it's a little bit more appropriate for presentation to the owner. So again, every time when the owner asks us, now we can answer those questions. So now there's a questions on the chat. Why we didn't put the withdrawals? It's because it was personal use. The withdrawals, no, we didn't put the withdrawals. We put them right here, 6,000. How do we know what we should put in the statement of owner's equity? Well, owner's capital, that's a standard form. Those are standard things which has to be included. So we haven't talked about yet, but we're gonna start going over. Once you can see is on the statement of owner's equity, we always start with what was in the very beginning, how much the owners contributed, how much is the income from the current period, and how much is the withdrawals that owner take, and the ending balance. Next period is going to start again with the beginning balance, but now beginning balance will going to be the ending balance of this period. We're going to see how this works. So from here we can see the link between one statement and another statement. What's the link? The links are the numbers which flowing from one statement to another statement. As you can see, in the very first place, I have net income, right? And from the income statement, I have this net income, which net income goes to owner's equity. After that, I have from the owner's equity, goes directly to the balance sheet. From the owner's equity statement, goes directly to the balance sheet. Those are the links that we have on the preparation of the one statement to another statement. First link again is income from the period goes to the owner's capital, and then from the owner's capital, move to the balance sheet. Now, when the owner asks you, where my $287,000, you're going to say, in cash, you have 172,000. In accounts receivables, you have 10, office supplies 7, and the land, $100,000. That's give you total $289,000. This is the assets that you have available. Once you pay your outstanding liability, 2,000, the rest is yours. Enjoy it. Now I'm gonna save this as an answer and I'm gonna post it for you. In the meantime, I'm gonna let you for break. So technically what we did in the Excel spreadsheet, we cover all those transactions. All those transactions from this slide and the next slide coming from here. what's happened with this company. Once we do those transactions, again, what we have to understand is when it says received, means the cash has been received. If it says on account, that means cash hasn't been received, it's receivable. For the payments, if it says paid, that means cash has been used. If it says on account or on credit, that means we have to pay later, and that's gonna be accounts payable. Once we put the transaction, it's gonna look the same way that we made it. Once we go further, we're gonna start preparing the statements. First statement that we're preparing is always and always income statement. Everybody wants to know how much money the business generates. In order to do that, we have to go through the revenue and expenses. Once we get the revenue, deduct the expenses, we're gonna see how much the company business generated. Second one is statement of owner's equity. We want to see the owners wants to know how much is his capital. And after he found how much is the capital, he wants to see where are the money. So first one again, the income statement, we're going to show the revenue, service revenue. We're going to have now the expenses here broken down to the revenue, rent expense, salary expenses, utility expenses. Total net income is $43,000. That $43,000 become part of the owner's equity, statement of owner's equity, which always starts with the beginning balance. How much the owners invested, we're gonna add the net income. We're gonna deduct the withdrawals, and we're gonna show how much left in his capital account at the end of the period. Then we're gonna prepare the balance sheet. In the balance sheet, we're gonna list all the assets on one side, and on the other side, it's gonna be liability plus equity. And we're gonna make sure that those are in balance. So what are the links again? The links is that once we get the net income, that net income flows to the owner's equity. Once we get the owner's equity, that amount's gonna flow to the balance sheet as a owner's equity. For the cash flow statement, I'm gonna explain now. The cash flow statement is the different statement, which you're gonna see in accounting 1210. In accounting 1210, you're gonna learn how to prepare the cash flow statement. The last thing that left is a comparison between the accounting standard for the private enterprises in the international financial reporting standards, which comparison right now will be impossible because you don't know the international financial reporting standards. We're just starting with the accounting standards for the private enterprises. So this comparison will make more sense once you start taking the intermediate financial accounting courses where the international financial reporting standards are discussed, and the person the teacher is gonna discuss it, then he can make the comparison and bring you back to this course to see what's the difference between one and the other. The main difference, if you want to put it in your mind, will be the international financial reporting standards are used from the publicly traded corporations, where the accounting standard for the private enterprise are used from the private corporation, sole proprietorships, and partnerships. And that's our chapter 1. Now I'm gonna stop the recording.